update. Alright, so just give me one more half a minute here to open up a file. Okay. Alright. I wonder if I could switch that out for that last one. We'll see. Because that could probably be fair. Okay. Alright, so folks, let's just take a little recap of the stuff we did last week. Right, so we are talking about depreciation. So we're going to take a bit of a brief recap. Hey, Mackay, how you doing? Doing some PoA for this, buddy. Alright, so the topic we are dealing with is something called depreciation. To depreciate means to lose value, right? So if you put on your shoes and you walk in your shoes, the underneath kind of weighs down a little bit, it has depreciated, right? When you buy a car, the instant you drive a car off the lot, you've lost 40% of the value. So could you imagine that? You buy a car for, let's say, $200,000. And the minute you move it from here to here, you've lost $80,000 of value. For what I don't know, that sounds kind of crazy to me, right? Other simple things, like for example, if you have a house at the beach, over time, even if you don't go and you don't use it, the sea blast kind of wears it down, right? If you drive your cars on Trinidad roads, they mash up kind of quickly. So things depreciate or lose value through wear and tear. The major one is wear and tear, which is through use, right? We also have obsolescence, which is when technology advances, right? Like I have an iPhone 8, and most kids will laugh at me, right? Because now they have 16 and 17 coming out this year. So something becomes obsolete when it can no longer meet the demands placed on the asset, right? So when newer things come out, they are better, they are faster, they're fancier, and they make the older things look kind of dumb. Nobody wants them anymore, so the older things lose value. Depletion had to do with when things are used up, specifically with reference to biological and geological assets. So like for example, if you have an oil field, when you extract oil from that particular deposit, there's less left in it. So that deposit is now worth less than it was before. But the oil in the ground by itself, okay, you have a value attached, but it only becomes worth something when you extract it and refine it. So you have to take it out of the ground, right? And like crops too. You can have an acre or a dozen acres of fruit trees laden with fruits. And they have a worth because you could sell them for this much in the market. But if you don't take them and sell them, do you earn any money? No. So you had to pick them and sell them. So it's like a kind of necessary loss in value, right? And the last one is the fluctuation or passage of time. So this is what I was kind of talking about with respect to like when you have a house at the beach, or even if you buy clothes and you say, I'm going to put this away and use this at some point, and you forget about it. And then you say, hey, I forgot I had this, and you take it off the hanger and you do so, and it doesn't go back. So like the elastic kind of dry rot, or it have holes, moths eat at it, whatever the case is, right? Now, that's just 4 causes. There are other causes, and I do encourage you to do your own research and what's the other thing called? To do your own reading, long story short, right? Now, we're not going to go into too much else of the the rationale and that kind of stuff. I mean, that's there for you all to read. Alright, we have some additional notes there. Anyhow, so we have 2 methods that you guys have to know for CSEC PoA. You have to know how to calculate using the straight line method and what we're going to talk about today called the reducing balance method. Alright, so the straight line method had a formula: cost minus residual or scrap value divided by the number of years. EUL, estimated useful life. Alright, so we had a definition of cost, we had definitions of residual value and EUL, and we said the straight line method works best for assets that were even. Like for example, these desks and the chairs, they basically provide the same amount of value year to year, right? Whereas stuff like computers, phones, cars, they tend to provide more value in the earlier years, and as time passes, they become a little less capable because they kind of wear out, right? And you have to spend more on repairs and replace parts and that kind of stuff, right? So the straight line method works good for certain types of assets, or it works better for them, right? So we took a look at the example. So we would have usually some information you have to read through, and then you have to extract your key bits of information: the cost of the asset, the number of years for which we expect for it to be a value, and the residual value, what we expect it to be worth at the end of its useful life. So we have a few things you have to be able to do. We have to calculate the depreciation charge per year using the formula. We have to be able to make the general journal entry, right? So again, there are, just now, hold on. Avinash, yeah, we're doing some PoA right now. We're doing the math later. And we did about 7 years worth of it so far. Today's the last day. Check back up past 6 months now. Yeah, sorry guys. Right, so we have a debit to income statement and a credit to the provision for depreciation account. Alright? And because it's the same value that is being used every year, I don't show this four and 5 times, right? To me that's kind of redundant. Alright? Anyhow, now the T account is where things get a little tricky for some people, right? So we have this T account here, and of course looking at something static is never really that fun. So what we're going to do is I want to actually get into the reducing balance in one time. So what I'm going to do is we're going to get a new page here. Let me open up a text box and then we'll go into it one time. Alright, so again, you can take down as many notes as you want. You could wait till the end or get the PDF, but I always recommend you write your own notes. Well, why is this transparent? Alright, good. Alright, there you go. Let me just check to see. Okay. Alright, so let's go. Alright, so the reducing balance method of depreciation. Right, so I mean obviously I'm typing, so I'm probably gonna be able to do that faster than you can write. Right, give me 1 sec, I'll check something real quick. Yeah. So there's not much in the way of notes, right? So under this method of calculating depreciation, right? The asset loses value at a constant rate or percentage. A constant percentage rate. Note, this does not mean a constant dollar value. Right? So what happens is that the amount for depreciation decreases as time goes by. This is in keeping with the assumption. Cheryl, why am I always the first in? Cheryl, someone said before you. Alright, anyhow. With the assumption that certain assets provide more benefits in the earlier years of their useful lives and less benefits as they age. Alright? As the benefits from the asset is derived from the use of the asset, 2 must be the expense that is matched against said benefits. Right, okay, so I feel like that's enough notes. Hey Sabrina, how are you doing? Right, so the reducing balance method of depreciation. So under this method of calculating depreciation, the asset loses value at a constant percentage rate. And like I said, I make sure to say, note this does not mean a constant dollar value. Matter of fact, it's the opposite. The dollar value actually changes every year. Right, but that will only become apparent when we do some calculation, which we'll get into very soon, right? So what happens is that the amount for depreciation decreases as the time goes by. This is in keeping with the assumption that certain assets provide more benefits in the earlier years of their useful life and less benefits as they age. Right? So as the benefits derived from the use of the asset decrease, so too, which is two O's, sorry. So too must the expense that is matched against said benefits, right? So if you derive plenty benefits, you match a larger expense for depreciation against those larger benefits. As the benefits decrease because the asset ages, and as it ages, it's less capable of providing benefits. So as such, because it's providing less and less benefits, you charge less and less depreciation. Right? Maybe you can say that, right? In other words, as the benefits go down, so too does the depreciation charge. Alright, so just a different way. Hey, Free Fire, how are you doing? Yeah, different way of saying the same thing. Okay, cool. Alright, so what we'll do after is we'll get into an example and some calculations. Hold on, how can I? Okay, I could do that. I could do the calculation on one page, copy and paste the table across the next page, right? And then paste it as an image. Okay, I can do that. Alright guys. Okay, no problem, you do your thing. Alright, Shiloh, how are you feeling with those notes so far? Simple and straightforward, or any questions? Or anything seeming confusing?
No, sir, nothing.
Alright, cool. Alright, yeah. Ladies and gentlemen in class, how are you feeling with those notes so far? Simple enough, they're not complicated, right? Alright. Yeah, notes don't have to be complicated, they should make sense. Right? If you get fancy to go further on, it's always good to understand things from a very basic perspective and be able to articulate, to say what you mean, and to understand what you mean. Okay, so let's see. What is a nice rate to use? 10%? 10% is a nice rate. What value are you using? So, yeah, for 3 years. Okay, cool. Oh, hey Kenny, how are you doing? Hey Kenny, doing some PoA phone calls first. We're doing maths half past 6. Right, so just waiting on some folks to finish taking some notes there. Again, no rush, you take your time. Alright. now when we're laying out the calculation here, there are different ways you could lay it out. Some teachers like a kind of vertical, continual approach where they just keep subtracting and going down, right? I'm not a fan of that approach. Nothing is wrong with it, they're not bad talking it. I just said I don't like it. There's another way that is a bit more tabular in structure, and you could also use that way in regular maths because depreciation is a topic on regular maths, right? Doesn't come very often, but it does come every now and again. So I guess as a PoA student, you're supposed to have at least a bit of an advantage in being able to do questions like that. Right, so give me one sec. Where is the thing? There is not the thing? Oh, interesting. Alright. Alright, wanna do some calculations now, right? Yep, you got everything? Okay, cool. Alright, so let's go next page. RBM exam. Okay. So let me zoom in here. Alright, I'm gonna put okay, so this is recent balance method example 1 in field. Right, so the cost of the asset is $10,000. The depreciation percentage is 10%, and the EUL in terms of years is 3 years, right? So we're not going to be doing like a whole long table or long T account, right? Keeping it kind of short and simple, right? Now the first port of call when you are doing the depreciation, is usually the calculation, right? You need to know the method that you're using. In this case, we're doing the RBM is reducing balance method, right? The cost of the asset here is 10,000, right? The depreciation rate, right, which is an annual percentage, right? So 10% per annum or per year. Alright, and of course the EUL is the estimated useful life, which is the number of years for which we expect the asset to be of benefit or to provide benefit. Right. Now, like I said, there is a vertical way and there's a kind of more tabular way. So I'll show you both, right? But I'll show you the way I prefer first, right? So we have the year, the balance at start. Should I do that? Okay, that's fine. Alright, cool. Give me one second. Value. Oh. Alright, cool. Yeah. Okay, so let's see if we could. Okay. Yeah, that's fine. Alright, we just have 3 years, right? So we have 3 years of that. So 3. Okay, so let's take out where? Yeah, that was kind of tough, right? Right, so what's the value at the start of year 1? So when you now buy the asset, the value at start is the cost, right? So you're starting with that. Sorry, this is supposed to be NBV. NBV stands for net book value. Sorry, what? Right, and NBV, net book value, is the value of the asset after having deducted all depreciation that we've charged on the asset thus far. Alright? Yeah, sorry about that. A little sleepy. Yeah, doing some. Is this maths? No, we're doing some PoA today from 4 to 6, and then we're doing some maths later. Last multiplication session, right? 6:30 this evening. Okay. Yeah, sorry about that, guys. Right, yeah. So, like I was saying, the value at start, so the net book value is the cost minus the depreciation, right? Now, at the start of the asset's first year of life, there's no depreciation at the very, very start, right? Because when you now buy the asset, you didn't use it yet, right? Like you now buy your shoes, still in the box, you use it. So there's no depreciation. It hasn't lost any value through any particular means. So at the very, very, very start, the cost is the 10,000, right? Right. Okay, cool. Right, now, the depreciation that we calculated is always 10 plus whatever the value is of, whatever that percentage is of the value at start. So, what we're going to do is multiply this by that same value. And then, what we do is we subtract going across. So, the value at start minus the depreciation. And why are we subtracting depreciation? So again, it goes back to what is depreciation? It's the loss in value of an asset. So if your value at start is 10,000 and you depreciated or lost 1,000 worth of value, your value thereafter at the end of the year will be the difference. 10,000 minus 1,000, which is 9,000, right? So your net book value at start, you charge your depreciation on it. Now, whatever the rate is given by the question. Alright, it's not always going to be 10%. It could be 10, it could be 12, 15, 20, it could be 8, it could be 5, whatever, right? 40 for all we know, alright? And then after you find the value, that percentage of this value at start, you subtract it from the value at start to find the value at end. And now, the value at the end of year 1 becomes the value at the start of year 2. So this value at the start of year 2 is $9,000. Okay, and guess what we do? We find 10% of that value. Remember what I said in the notes, right? I said that, hold on, let me just zoom back in here a little bit. Right? Under this method, right, the asset loses value at a what? A constant percentage rate. Note, this does not mean a constant dollar value, right? So the rate at which we are depreciating stays the same, 10% every year. But it's 10% of a different value every year. Alright? Click in? Making sense? Okay. Right. So when we find 10% of 9,000, we get 900. And guess what we do with that 900? We subtract it from the value at start. So 9,000 minus the 900 is going to give us 8,100. And guess what we do with that value? The value at the end of year 2 becomes the value at the start of year 3. And guess what we do now for year 3? We find 10% of that value, which is 810, and we subtract it from that value, which gives us 790. And that's where we stop. Because they did say it was only 3 years worth, right? How are you doing, Jade? Afternoon. Right, so this is one way to do it. Alright, so those of you who've done this in school, does this look familiar? Yeah? Alright, so I know you didn't do it, but it's looking okay? Alright, if you have any questions, please feel free to ask us another one. Alright. No Owen. But actually, this is on the math syllabus, but no, this is PoA we're doing right now. We're doing math 6:30. So check back in about an hour and a half, right? Alright. Okay, so the question is now, after we've done our calculation, what do we do? Alright, so I'm just checking on Kaylee and the shadow. Right, so shadow, how are we feeling with what we see in there as the calculation table? Any questions, comments, queries, or are we okay with that one?
Okay.
Alright, cool. And Kaylee, what about you? How are you feeling with what we have on the screen so far?
I'm okay with it so far.
Alright, cool, lovely. Okay, so now we have to do the T accounts. Alright, so give me 1 second. Take that out. Right, so I have to copy and paste that. So what we need now is to do the journal entry and the T account. Can I do the journal entry across here? I could. Here. Alright, so we're going to let's zoom in here a little bit. So like that. Alright, so what we need, hold on 1 second. Alright, so we have the general journal entry that we need to enter, right? Just give me 1 second. I'm trying to figure out if I want to go. Could go horizontally. I would save some time. Okay. Right, so for the general journal, this is what we're gonna do, right? So 1, 2, and I could actually okay. Alright, so just give me 1 second. Let me just show you what I'm working with first, and then you can copy down or whatever it is, right? Alright, so we have the date, we have the details, and of course we have debit and credit, right? Debit. Hold on. Yeah, so oh, no. Right, oops, no. There you go. Alright, so we have 3 years with the depreciation. That's just boom, boom as well. Okay, so I'm only doing it this way to save a little bit of time and space, and I'll explain why. Alright, so we don't really have years per se, as in like 2022, 2023, right? We just have year 1, year 2, year 3. Good. Like and subscribe. Thank you, Thierry. Alright. Okay, so we're just going to assume a 31st of December year end for this, right? Right, so the general journal entry, and the debits and credits to record depreciation, right? Oh, hello, wife. How are you? Good to see you. Alright. Yes. So normally we debit the income statement, and we right, that's what I do. And we credit, hold on. The provision for depreciation account. Alright, so yeah, it's a little long. Let's zoom out a little bit. Right, now in year 1, what is the depreciation charge? The depreciation charge is 1,000. So that goes here in the debit column, and of course in the credit column as well. Right? Now in year 2, we have the same debit and same credit, but we have a different figure. What's the figure in year 2? 900, right? That's in the depreciation column, right? So depreciation column here, in year 2 the figure is 900, right? So 900. And in year 3, the depreciation charge is 810. Right, and of course the the narrative or narration is to record the depreciation charge per year. Scrubbed. Oh, okay. Right. So what the general journal entry shows is the debits and credits and which accounts are debited and credited and for how much. Right? And the little extra piece of the narrative or narration is just a brief description of the transaction. Alright. So like I was saying, there is another version of this, and that version is where instead of debiting income statement, we debit the depreciation expense account, right? So that's the one that you, huh? Yeah, and then after you will actually do a second entry where you debit income statement and credit the depreciation expense account. So that account actually, huh? It is, but the funny part is, so this is how I learned it. This is what you would find in most PoA CXC secular textbooks. That version I learned when I went to UE. The funny part is that's what they expect you to know in Form 6, despite the fact it's not taught in Form 5. Yeah, fun times, right? Right. So don't jump to that yet. I mean, I will not force you to do it or try to stay to doing it. That's fine. It's a cram fest. It's not how I like to deliver accounts, to be honest. I mean, I have like a once a week lessons class on a Saturday morning as well, and we're able to finish what we had to finish kind of tight, you know. And that's unit 2. Unit 1 is like bloated. It's more of like financial stuff, and it's good. I just wish, like, instead of having the exam at the end of lower 6, you had the whole of the lower 6 to do all 3 modules. That'd be great. But we don't have that. So we end up trying to cram. It's like, you ever went to TGI Friday and ordered a burger? The man trying to eat that burger in one bite. Not a good idea, right? No. If you had the time to bite and enjoy and stick your fries in and dip it in some sauce or whatever you like to do, cool. You can enjoy the thing, right? Cool. But not what it is now, right? I would never try to actively discourage somebody from pursuing accounts, because I love the subject, just not how it's delivered right now. Not how it's right. You know? But there are other avenues to learn accounts if that's something you want to do. But again, you can do that later on. Our mission right now is to prep for the next 11 months to get to this point here. Alright? And don't worry, we have time, but it's fly. So you have to make use of the time. Okay, yeah, so the funny part, sorry, I kind of veered off into a story there. When I went to UE, that was the version. Now I was taught there's no such thing as a depreciation expense account, and then I go on to lo and behold textbook of depreciation expense account. Okay, so what we teach is kind of more the British version because we are descended from that version because we were colonized at a point in time and we model our syllabus after theirs and hence use the materials come from. And then when they go to tertiary education institutions, these American textbooks. Fun times. Alright? So, but the funny part is I actually like that version better because it kind of creates a consistency between the depreciation and the other expenses because almost all other expenses will have that. Right? When we do accrual prepayments, you'll see in the expense accounts, there's an amount transferred to the income statement. That's the amount we use up for the year, which makes sense. Now, again, you kind of see it here too, but it's just that there's no depreciation expense account. There's just the income statement and provision account. So it is simple, it's more compact, and it actually is the net effect of even using the expense account. Because think about it. If when you did the recording, you debited the expense account, and then afterwards you credited it to transfer out, the debit and the credit cancel, and that account is closed up. And all that's left is the provision account and the income statement. So this is like the faster version. Long story short. Alright? Okay. Alright. Alright, Zavi, you okay with what you're seeing here? This is what you did when you did in school too? Or you did the expense account do? This one. Alright, cool. Alright. Alright, so you know how we're looking there. Right, you're able to connect with which figures came here and where they came from? Yeah. Alright. And Kaylee, how are you feeling with that stuff on your screen so far?
I'm okay with it.
Alright, Charlie, what about you?
Okay.
So far so good? Alright, cool. Alright, pre-tabby, yes, math later from about 6:45, somewhere around. Aiming for 6:30, the last day, but I haven't printed any paper, so I might be a tad late. But fear not, I will be. Okay, so after we've done the journal entries, the next port of call is the T account. Alright, cool. So, where am I going to put that? Here. Okay, cool. So, actually, I should, and okay, I know what I'm going to do. Alright, so we're going to put that one on, no, not this one. Right, now for what we're going to do now, which is the T account, you could use the table, because all we're interested in is the middle column here. Alright? This piece here. So you could use just the table, or you could use the journal entries. Alright? And pull from right here. Right, but as you can see, it's the same figures. These figures came from where? These figures came from the calculation table, not so? It doesn't matter which one you use to feed the T account. It's all going to be the same once you do it properly, right? Okay, so just give me a sec to get my T account. Alright, okay, so I want to take a look. Guess I'll use that. Alright, okay, so let's go ahead. We're going to zoom in, take that out. Alright, nope. Alright, so the provision for depreciation, and then I'll just put asset. Right, because if whatever asset we have, this will be its provision for depreciation account. So if you have a motor vehicle, it will say provision for depreciation motor vehicle. If you have furniture or fixtures, it will say provision for depreciation furniture or fixtures. Alright? So of course the column headers are dates. So some people like to put particulars, some people put details. I'm not going to worry with the folio column because it's almost never used, so particulars. Okay, so never use that. Sorry, man. Hey, well, Louis.
It's Caitlin time.
What's that?
It's Caitlin time.
No, Caleb was supposed to come with Caitlin to help Mishka with his class, and that's
Michigan's inside?
Mishka, yeah.
Serious?
Yeah. She have a good
Yeah.
yeah, so we need to. Okay, so let me do what I do. Yeah. Or details. You can put details if you want. If you prefer. Alright, cool. So, let me put that in my book. Alright, so we highlighted a kind of mango color. Alright? Yeah, okay, so as we know, each account has two sides, right? We have a debit side and we have a credit side. Right? So like we saw on this page, what we do is we credit the provision account. Now let me explain why. So just to recap very quickly, what is depreciation? A loss in value of an asset, right, over time. Okay. An asset has what type of balance usually? A debit or a credit? A debit. So if an asset loses value, that debit value theoretically should decrease, right? Now, remember there was a concept we talked about a couple of weeks ago called the historical cost concept that says assets should be recorded at their historical cost on the balance sheet, right, and in their accounts. So the actual cost we pay for it should always appear on the books. That should never be adjusted up or down unless you're buying more or unless there's a reason for doing so, right? So even if we depreciate, we don't subtract the depreciation in the assets account. We have to create another account, which is what this account is, the provision for depreciation account. That's what it is. That is what we call the classification for this. It's not an asset, it's not a liability, it's not a revenue, it's not an expense, even though there is a concept of a depreciation expense account, right? What it is actually something called a contra asset account. Right? And what a contra asset is an item that is used to decrease the value of an asset in the balance sheet. Right? So depreciation or the provision for depreciation is one of the two you'll have to know about. The other one is the provision for bad debts, right? And we'll come to that. If not this month, we'll definitely cover it in July. Okay. Alright. So when we okay, right. So long story short, the assets account will have the debit balance, which is the value of the asset, the historical cost. And the credits that we make here will be used to show the decreases in the asset's value. So the credits here, right, ideally is wrong. The credits here could theoretically go in the assets account if the historical cost concept was nothing. And what that would do is it would cause the value of the asset to decrease over time. But because of that concept, the historical cost concept in existence, we cannot put the decreases, the depreciation in the asset account. So again, instead we have to create a separate account called the provision for depreciation account to house the provision for depreciation charges. And those will go on the credit side to, once again, we put on the credit side here because the asset has a debit balance, and to decrease that debit balance, you have to have a credit item or credit balance. Okay, so in year one, right, the amount, right, so what's the amount in year one? In year one, it's $1,000, right? Right, and the details will say income statement. Right, so this is the entry that is made, and then thereafter, at the end of the year, we also balance of the account, so balance carried down. So the figure in the account is 1,000. Alright, so what I'm going to do, guys, is just so again, because the double lines won't really show up very well, right? That's them there. Can you see those double lines? Not really. So what I'm going to do is I'm gonna bold those items and I'm going to put them in a color. Let's put them in a green one. Right, so those bolded and highlighted items, that's the total on the debit hand side. Right, so instead of having like a double line, because like I said, it would be difficult to see, I'm just going to put them in that particular format. Okay, so at the end of year one, we have a balance carried on of 1,000, right? At the start of year two, balance brought down is that same 1,000. Nice. Now, in year two, hold on, give me 1 second. Just, whoa. How did that happen? Okay. Now, in year two, what was the depreciation charge? 900. So we go on the credit side, we put 900. Alright, the details will say income statement as per usual. Alright, and now the total here will be 1900. So the balance carried down at the end of year two will be 1900 as well. Right, so you have your 1900 on both sides. free file. Yeah, we're doing paper one March, Jan 2025 from about 6:30 or so. Right. So at the end of year 2, there's a balance carried on of 1900, and that's brought down to the start of year 3. And in year 3, we charge the depreciation one more time. Now, in year 3, what is the figure we use? We use 810. Right, I'll say income statement. Add it up. Right, and that is the big and bad provision for depreciation T account for the reducing balance method. Right? So again, as you can see, it actually is kind of repetitive in terms of what is done, and the thing that has changed is how much we use. Right? Just give me 1 second. So it's going to pop back real quick to the what you call it, the straight line method. So under the straight line method, what we notice is that, hold on, let me zoom out more. What we'll notice is that every year for the income statement figure, right, how much is it? The same one, 2,000, right? Because under the straight line method, we use the same amount every year. But under the reducing balance method, however, the amount changes. But what we do is it does not, right? It always goes, the depreciation charge for the year always goes on the credit side of the provision account. And even though it changes, like I said, we always credit it. So we always credit the provision for depreciation account. And we just add it on to the balance brought down, carry on the new balance, and repeat. Alright, so this will go up for 4 years, 5 years, 10 years, how many ever years. But as you can see, the process doesn't really change. All that changes is the figure. Right? And again, once you do either your calculation, like we have here, either your calculation or you have your journal entries, which will obviously have the amounts that we're going to use for the debits and credits, right? Filling in the provision T account becomes a little simpler, right? Because yeah, like I said, this particular topic tends to be a bit difficult for some students to grasp, right? Whether it is the conceptual portion of, hey, what are we doing and why? Right? We're depreciating. Okay, why are we depreciating? Because assets lose value because we use them. Okay, makes sense. But how do we account for that? Where do we put what? Right? So how do we calculate it? So we have two methods: straight line, reduce and balance. Okay, cool. What do we do? Alright, so after you find the figure, after you do your calculation, you have to do this debit and this credit. Why are we debiting income statement? Because the loss in value of an asset is an overall loss or an expense to the business, and expenses are debited to the income statement at the end of the period. That's the closing entry. And the credit to provision is because this account, right, is used to show the decrease in value of the asset. I mean, we use this account because we can't put that depreciation figure in the assets account, right, because of the historical cost concept, right? And again, because assets decrease with credits, that's why we are putting the yearly charges for depreciation on the credit side of the provision account. Okay. Alright. So Cheryl, how are we feeling with the T account? Is it looking alright? Any questions? Or are we good? Alright. Kaylee, what about you? Are you okay with that?
Yeah, I'm okay with it so far.
Alright, lovely. And Kaylee, what about you? Alright, cool. Exactly. Talk enough. Good there? Alright. Alright, so you know how it's looking so far. Okay, now we of course have two more things to do, being the income statement extract and the balance sheet extract. However, I feel if I try to do too much at once, it will be a bit overwhelming. Now, as if it already doesn't seem overwhelming. So what I want to do is I want to give you guys one to try, and we're going to do it piece by piece. We'll do the calculation first, correct that. Then we'll do the journal entries, correct that. And then we'll do T account, correct that. And once we have some time after, we will do the extract, so we call the extract of the financial statements. Alright? Okay, so what I'm going to do is okay. RBM, use and mark method. CW is classwork, Q1 is question. Right, so let's keep it simple enough now. So the cost of the asset. What value I want to use here, boy? That's not. Okay. Let's use $20,000, right? Let's do depreciation percentage. Let's keep it at 10% now. Let's do the same. Let's do the same 3 years, just to keep it simple, right? Okay, so what I'm gonna do, we're gonna go back here. Alright, so what I did is I have the example on the left hand side of the page, and I have the question you're working on the right hand side of the screen. Sorry. Alright, so basically what I want you to do is do this table for using this information here. Alright? Let's take it one at a time. Okay, you're ready or you need a minute again to finish off the calculation? Isn't that begin? Go ahead. Alright. Okay, let's go. Alright, so this is the cost of the asset here, and that becomes the net book value. It's very, very standard here. Right. Now in this case, the depreciation rate stayed the same, right? I didn't change it just to keep things simple. So what are we finding 10% of? We're finding 10% of the value at start. Right. And then what do we do after that? We subtract 20 minus 2 is equal to 18. Right, 20 minus 2 is 18, and then we take the value at the end of year 1, and it becomes the value at the start of year 2. And then what do? We repeat. We find 10% of that value at start, which is 1800. And then what do? We subtract that 1800 from the 18,000. That gives us the 16,002. That's the value at the end of year 2. What do we do with the value at the end of year 2? We carry it down to the start of year 1. Sorry, the start of year 3. My bad, I said year 1, year 3. And then what do? We repeat. We find 10% of that value, we subtract it from the value at start, and we get the value at end. And that's where we stop there. Well, it was an apple, it was a Quest bar. Nah, boy, I was hungry. Alright.
Do you have any stats, possible questions?
For math?
Just math.
Let me see. One second. Lesson plans. Yes. Stats and prompts, yeah? So this was sent in the PDFs?
Yes, please.
Alright. Let's see what I have here. Okay. Oh. Alright. One second. Alright, so that's in January, and I'll send you me as well, right?
Alright, perfect.
Alright, cool. Alright, yeah, okay. So how are we feeling with those calculations thus far? You okay? Sure? Alright, cool. Katie, what about you? You got this figured? Alright, Gabby? Alright. Alright, Shiloh, who's looking like that? You okay with that table? How about Keely? How are we feeling there with that stuff?
I'm good with it so far.
Alright, cool. Alright, so from here now, what I'd like you to do is I'd like you to do the T account, right? Don't worry, if you do the I want you to do journal entry, but I kind of want you to get the T account a little faster, right? So hold on, give me one sec. So this is the T account on top, so let's put it on the top there. Right, okay, so what okay, no, on the wrong side, my bad. So I want you to use this information on top here to populate the T account. Alright, so of course it's the highlighted items So these, hold on, that's not the correct figures. Yep, there you go. Yeah, so sorry, so these figures here. Alright, so the figures kind of highlighted in the kind of orange, yellowish orange color, right? I want you to use those figures to populate the T accounts down here now, right? So all that's going to change actually is the amount you put in every year, the income statement figure. Alright, so in year 1 the charge is 2,000, in year 2 the charge is 1,800, and in year 3 the charge is 1,620. So those three figures are what you're going to be using in each year here. So I kind of color coded it to help you out a little bit, right? So just match the colors, right? For those particular, so the colors on top, those figures go where the colors are below. Did I not do this? Oops. Oops. Mm. Mm. There are more mosquitoes out now because it's rainy season, yes. No, no, no. take a look, right? So with the provision for depreciation account, right? And so in year one, on the credit side of the account, right, the income statement figure, right, is 2,000. So we put that there. Alright. Oh, I kinda also populated some stuff already. So let me take out some of the extra stuff down here so it doesn't look like we're trying to read over a static thing, right? That's annoying to me. So right. So we put in are you not looking anymore? Oh, that's why. Right. Right, so the 2,000 goes here. Right? The balance carried on therefore will also be 2,000 because that will be the total on this side across here. When you add up one figure of 2,000, you get 2,000. That's the balance I decided, right? Now, the balance at the end of the first year is 2,000, and that's brought down to the start of the second year. In the second year, we charge in how much? That's the 1,800. Right? 1,800. Boom. Right. We add up the 2,000 and the 1,800, we get 3,800 now. That becomes the balance carried down at the end of the second year. Right. That balance now is carried down here. 31. Boom. In the third year, the charge for the income statement is 1,620, so that goes here. We add those two up, we now have 5,420. Is my head blocking? My head is blocking, sorry. Yes. And that total goes here as the balance. Kenya, what are we doing? We're doing depreciation? Yeah. Almost say I thought it was PoA, so we have maths, yes, no. Yeah, we have maths. Maths is in an hour. Alright, about 6:30. Alright. Okay, so okay. No, crop. The guy there. Okay, yes. So, 1 second. How are you feeling with that? Are you okay? Yeah, I'm okay? Alright, Shiloh and Keely, let's give them a quick G in the chat if you're good with that. Please and thanks. Yeah. Yeah, so give me a G if you're good with that, or give me a R if you need me to re-explain. Okay. Alright, Shiloh, we cool with the fee account?
Yes, sir.
Alright, cool. Alright. So what I want to do now is I want to show you what the extracts of the financial statements would look like. Using the same question we have here, I'm just going to give it to you guys kind of wholesale. Right? When we come back next week, we'll practice a couple more of these questions and then we'll move on from there. Okay, so this is the income statement. So income statement extract. Right, for the years ended 31 December, right? Now I'm just using 31 December as a generic year end, alright? Okay, so what I'm going to show you here is the yellow, blue and the green items. They are currently, as you can see, in the depreciation T account. But the details say income statement, which means that the income statement is the other side of the entry. Alright? Now, these items, the yellow, blue, and the green, are on the credit side of the provision for depreciation account. Which means that, and what do we know about double entry? Every credit needs a corresponding debit. So the debits will go to the account named in the details section here. Now the income statement itself is not necessarily an account, but you can consider it like that for our purposes, alright? And debits to the income statement go in the expenses section. Most of them, right? There are some debits that will go up in the cost of goods sold section, but we'll talk about that next time. Right. So we have the provision for depreciation. Right. So we have so year 1, year 2, and year 3. Right. So in year 1, the depreciation figure was 2,000. So that will go here. In year 2, the depreciation figure was 1,800. That will go here. And in year 3, it was 1,620. That will go here. Alright, so let's color code them now. So they kind of flows a little better. Alright, so the yellow to the yellow, blue to the blue, green to the green. Yeah, I guess what I could do is I could put that in grid lines, some borders, so it looks a little more like a table than just something floating in space there. Okay. Now, the balance sheet extract. Alright, again, I'm just using 31st December as a generic year end. As we know, different questions. Oh, hey, how you doing? Shy pretty, yeah, sorry. Different questions can have different year ends, right? So we know in the balance sheet, when we're dealing with depreciation, with the non-current assets section, and it has 3 headings, right? Cost, depreciation. Now it's really supposed to say accumulated depreciation, but just for lack of space, I'm just putting depreciation. Right? And then for the asset, right? So we have whatever the asset is. Well, I didn't give what the asset was. We just said it was an asset. Okay, cool. Right. Now, normally in a balance sheet that covers just 1 year, right, there'll be multiple assets listed here, each with their own information for cost, depreciation, and ultimately net book value. But because we're doing an extract to put the information for multiple years, for a single asset for multiple years, this is where we'll put year 1, year 2, year 3, that kind of stuff, right? Okay. Yeah, I think centering is fine. Okay, now the cost of the asset was $20,000, right? Now, watch me for a second here, right? Alright, hey Pauline, how you doing? The income statement figures, the yellow, blue, and the green, the income statement figures went into the income statement. The balance sheet will take the balances. So the balances go in the balance sheet, the income statement figures go in the income statement. So in the first year, at the end of the first year rather, the depreciation balance is 2,000. So that's what goes here. And you subtract going across. 20,000 minus 2,000 is 18,000. Alright? In year 2, the cost of the asset doesn't change. Now, this, what we're showing here, is the balance sheet extract. It's not the calculation table. Right? The first row will be the exact same, but that's the only time it will be that way. It will not be that way after that. These figures will match, but not the others, right? In the balance sheet, we have to show the cost of the asset, and the cost does not change. Even though the asset depreciates, the value goes down, but the cost does not. And you might be asking, well, isn't the cost the value? That was the purchase value, the value for which we purchased it back in whatever year. As time went on, the value, the book value of the asset decreased, right? But not the cost. Right, now, at the end of the second year, what was the balance in the depreciation account? That was 3,800. So that will go here. and then we subtract going across as well. 16,2, right? In year 3, the cost is still 20,000, right? And the depreciation in year 3, the balance is 5,420. So that goes in the balance sheet. And then you subtract going across and you get the 14,580. I'm trying to see if I have three other colors so I can kind of match those. Let me see. Number 1 sec. I kind of have an orangish one here, but then the others I don't. That's a brick color. Brick. I suppose that one I kind of put in a. Right, so these, I know these 3 colors aren't like the best colors to use, but that's how I kind of feel with that. Nah, I think that blue had a change. That blue a little too close to the other blue, the year 2 stuff. Maybe a little brighter green. Yellow, yeah, that yellow's a bit too much for it. That blue is also a little too much. That green might be the best thing to use. Alright, so that's where we pull that information from. Back in a little bit in case you didn't finish. So if you're wrong, that's who's in across that's really color. That's good trouble. Alright folks, yeah. So, I mean, for this question, we did kind of everything with the exception of the journal entries, right? I don't think that was, can I rush it down here, boy? Alright, let me give it to you, right? So, you know how to copy it down? We could if you want, right? Alright, so we have, debit, credit. Right, now the journal entries are supposed to be made before the T accounts are done, eh? So this is just kind of tagging it on, right? So every year we make the debit to income statement and the credit to the provision for depreciation account. Right, so in year 1, we have which for date column? Look at that. Date, details, yeah, okay, cool. Right, so in year 1 the depreciation was 2000, right? So that's 2000 here. So I wouldn't worry with the narration, right? In year 2, it was what? 1800. And in year 3, it was 1620. Yeah, so this was supposed to be done before. Right now, in contrast to how I did it across here, where I did it kind of going across, sorry, year 1, year 2, year 3. Oh crap, sorry, 1 second. Yeah, so in contrast, what I did here was I showed it like every year going down. As you can see, it gets pretty repetitive, right? The advantage of doing it like this, hold on, this particular way here, is that you kind of save some time by not having to write over this thing multiple times. But then the disadvantage is you need a lot of space horizontally, which you may or may not have, right? The advantage of this method is that it doesn't take up, it's not very expensive horizontally. It now becomes expensive vertically, and it becomes very repetitive with these two things happening over and over. And if you have to write the narration, then it becomes even more repetitive, right? To record the depreciation chart for the year, blah, blah, blah. Right? But anyhow, that's where we will stop for today, folks, right? So I know I'll give you quite a bit about it and chew, so you have to go and kind of process it. Alright? So of course, as per usual, I will make a PDF of all the work we did today. I'll send it in the chat, so after I get the number to put it in the group chat, right? And I'll send also a link to the replay, so you can always go back over the stuff we did today. And of course, if you have any questions between now and next week, feel free to let me know. Right, so again, next week class should be as per usual, 4 to 6. The week after is a public holiday, so I don't know if I'll be having class that day, because I mean it's a long weekend, so I'm pretty sure families have some stuff planned. The week after we kind of resume, but I know by then some of y'all will be done with exams in school, I don't know. Because not long after the term ends, right? And of course for the July, August, right? So we start on the 14th of July and go to the 22nd, so we have 6 weeks. Accounts will most likely be 3 days a week, Monday, Wednesday, Friday. Normally I do 10 to 12, but because we have someone who came on, she came on yesterday, and she wants to do bio and chem. So I might have to factor that into the timetable. So Kayla will do the physics, geography, and like format. This young lady will do bio and chem. She might take over the admaths from me, she probably should take over the admaths. And we'll also have like little mini math classes, smaller math ones in between. So instead of the regular 2-hour classes, we might do like an hour and a half. So we might look at like a 9 to 10:30, a 10 to 12, or for lunch. But again, you'll get more info on that near the time. I had to process all that and figure it out. Alright, anyhow, so guys, that's about it for today. Alright, so Shiloh and Kaylee, that's about it. So look out for the stuff in the, the WhatsApp chat. And if you have any questions, please feel free to let me know. Okay guys, I'll go on. Bye.
Bye, sir.
Bye.